Thanks for that introduction. It's a pleasure to be here. Good morning, good afternoon, and good evening to everyone who has joined us. It's an incredible pleasure to be here, joined by my also illustrious colleagues on this panel, and I'm very much looking forward to the discussion. You know, every time we have a financial crisis or a recession, we learn anew about the ways in which the financial infrastructure does and does not support the most vulnerable households. This particular pandemic recession has been uniquely abrupt and deep and has affected the most vulnerable in multiple ways that have an impact on household finances. For instance, lost jobs or the inability to work, illness, and depending upon where you live in the world, it could also mean significant medical debt. We have already seen that hunger worldwide has escalated across the globe as a result of this pandemic recession. What I wanted to do is talk a little bit about what's happening in the US. The Gini coefficient in the US is 0.48, and that puts the US at 40 in the list of inequalities across the globe. The racial wealth gap in the US for household wealth is 8-to-1 white household wealth to Black household wealth. In the US, the impacts of COVID-19 have been worse for marginalized communities and for poor women, as Jerome Powell has mentioned. The financial infrastructure in the US has been, in my view, ill-prepared to support the most vulnerable Americans, largely because the efforts to ameliorate the impacts of COVID-19 have depended on congressional action, that's fiscal action, and the levers available to the central bank in the US, the Federal Reserve, are very few, and the uneven distribution of banks in the US, where low-income areas are usually not served or poorly served by banks, all lead to a picture which is not particularly helpful for vulnerable households. So let me start by giving a quick review of the actions that were taken by the Fed, the US Treasury, and the US Congress to initially blunt the economic impact of the coronavirus. So Congress passed 3 major relief bills in the US, which were intended to keep businesses and individual households afloat for a 3 to 5 month period. This was at the outset of the pandemic in the US. Among the elements in these plans were stimulus checks and a business loan program administered by the Treasury Department. The Fed also stepped in and, among other interventions, opened multiple lending facilities, primarily for corporate and municipal lending. And the Fed also used its substantial bully pulpit to advocate for congressional action on behalf of US households. And I'm going to review each of these in turn because they are interlinked to the financial infrastructure question. So stimulus checks were either deposited into accounts that taxpayers had used to receive income tax refunds, or they were sent to the last known address of the record for the taxpayer. The stimulus check administration was effective in pumping money out quickly, but the households that had not paid taxes in the last 2 years, which are often lower income households, there was a very onerous process of sending in your information in order to get your checks or to get the money. Physical checks went to those without bank accounts on file, and those checks were sent out last, about 3 months after the start of the stimulus program. So what we learned here was that using tax filing records was probably not the most effective way of reaching low-income, non-tax filing households. The business loan program, known as the Paycheck Protection Program, or PPP, was an attempt to loan money to businesses in return for those businesses keeping employees on the payroll. And there was a role for the Fed here in guaranteeing some of that money. The loans were funneled through banks, which acted as the intake and approval mechanism for the program. So the program was largely unsuccessful. Laborious application processes favored large firms with accounting departments. Small firms, which are most common in Black and Brown communities in the US, typically did not have the resources to file those applications. Relying on banks to make decisions about which firms met the criteria and which did not, plus a certain dollar threshold for each bank in terms of its ability to approve lending, meant that banks simply went with their customers and businesses with whom they already had a relationship So again, if you were a minority-owned business, meaning a Black or Brown-owned business, you were likely not to have that relationship and likely not to be favorably considered. So relying on banks also meant that communities of color where banks are sparse meant that there were fewer institutions to serve those businesses. And finally, the terms of loan forgiveness were at first unclear and later changed, which also confused small and micro business applicants. And the last issue was that Treasury ended up having problems processing the volume of applications that came through. So the lesson here is that the Treasury Department was ill-equipped to deliver this program, even though it was guaranteed by the Fed, and was ill-equipped to move the money where the need was greatest. Now let's talk about Fed actions. So let's remember that the Fed doesn't have the tools to reach down to the level of the household. The Fed relies on transmission mechanisms that allow its broad policy postures to be transmitted through the economy. As a result, the Fed could really only open up lending lines to corporations and to states and municipalities. And each of these borrowers are employers and can affect the lives of households employed by either the corporate or public sector entity. And in addition, state and municipalities can borrow to facilitate spending on social programs. The Fed facilities to corporations were used, but this did not have a large impact on inequality. The Fed facilities for state and municipal lending were underutilized because the interest rates were high relative to the time for repayment and for the projections on tax revenue in those municipalities. The Fed bully pulpit was important in focusing on the unequal impacts of the COVID recession on communities of color, the poor, and poor women in particular. And that was helpful as municipalities tried to launch social aid programs, but the bully pulpit was less effective in getting Congress to act with urgency and at levels that signaled an understanding of the scale and the depth of the devastation of household finances among the poor, low and middle income households in the US. So there was in addition to that, we also saw in the US a booming stock market while a real household wealth declined. And so inequality likely has increased. We haven't measured that, but it's likely increased because of the devastation in poorer middle income communities, but the uptick in capital gains and gain from the rather vibrant stock market after May or June. So in the US, the financial infrastructure was in fact overwhelmed by the abrupt nature of the downturn, its sheer scale, and by reliance on systems that were not appropriate for addressing inequality. And the Fed in particular tried very hard to leverage its bully pulpit muscle, but in the end, that does have limitations due to the way things are just set up in the US and the reliance on fiscal measures. So in fact, inequality in the US has likely increased as a result of the COVID-19 recession. And with that, I'm going to pass the baton back to Soleil.